today's absolutely phenomenal, outstanding, in my humble opinion, episode of The Compound and Friends is brought to you by Ground Floor. Duncan, here's who they are. Ground Floor is an award-winning wealth tech platform offering high-yield, short-term real estate debt investments directly to the general public. And when I say directly to the general public, I'm talking about almost 200,000 users with over $800 million invested on the platform to date. If you want to learn more, where do they go, Duncan?
Groundfloor.us.
Groundfloor.us.
64? All
Nice
right.
job, guys.
Compound and Friends, episode number 64. Thank you, John. Katie, I wrote this awesome introduction for you. And when I say I wrote it, I mean someone wrote it for me, but I'm going to read it. Katie is the founder and managing partner of Fair Lead Strategies, an independent research. You're nodding. I could do it. Trust me, I got it. An independent research firm and advisor focused on technical analysis. Prior to forming Fair Lead Strategies, Katie spent more than 20 years on Wall Street providing technical research and advice to institutional investors. Welcome to the show, Katie. Thanks for coming by.
Thanks. Yeah, good to be with you.
You excited to be here?
Of course I am.
I forget where I first started to either watch you or read you. What firms did you work at prior to Fair Lead?
Oh, gosh. Yeah, where would I start with that? I started my career in San Francisco, and I worked for a buy-side firm. Do you guys remember Wall Street Week?
Yeah.
Louis
Rukeyser,
Rukeyser's show. There was one of the elves, was Frank Cappiello.
Okay.
So I picked up a job. My first job out of college was under him.
The elves were like his regulars.
Yeah, his regulars.
Like our
Gail
JC Perez.
Dudak. If you,
Yeah,
yes,
yeah. Okay.
you got it.
Got it.
And
okay.
so that was my first job, and I was sat in this big office, hand charting point and figures.
I know, because that's what it was back then.
That's what it was. I didn't even have email.
You had graph paper.
That's right. And
Okay.
honestly, there's no better way to stay close to the market, right? And yet here we are with...
You know who says that too? Luis Yamada always says, I still do my charts by hand. I think for that reason, because it like forces you to really focus on what you're putting on the graph.
It's the day-to-day, right? Just
Right.
knowing you get that close to it. Today, of course, that's going to be a little rough for those hand charters, but...
Yeah.
Yeah.
So that was your first exposure to technical analysis by virtue of who you worked for, but you stayed with it. And
Yeah.
not everybody that starts in a discipline on Wall Street continues with it. So there was obviously some element to TA that really resonated with you.
Yeah, and honestly, it started before I got to that shop. It was actually in college. I had an internship, and I went to, it was at an advisory firm. They had on their desk the point and figure charts, and they were from Dorsey Wright. Do you guys know Tom Dorsey?
Yep.
Big personality in our small industry. And he just was the best mentor for me. So I worked for him in college for a couple of years. And then I was like,
early.
I was on the track.
Okay.
I was already into, I was sort of a math nerd. I was into finance. So I was already into markets. And I guess the way I think about the world was more a sort of left brain, and it really resonated with me.
Right.
And that was just my path established very early on. And I'd say the formative parts of my career were on the sell side. I worked for Morgan Stanley when I first moved back to New York City.
Okay.
Under Rick Bensignor. He taught me a lot of the methodology that I use today. Worked for MKM Partners for 9 years and BTIG most recently for 4 years.
How would you describe your style of technical analysis? Are you pattern, the supply demand? Like what is it?
I would say primarily top down. And oriented to indicators. So it's all about the indicators to me, because I think that's where we can get that sort of mathematical takeaway. Is it a buy signal? Is it a sell signal? It's binary in a way. And it takes out some of the guesswork, and that's what I ultimately
So top down meaning like market level, index level first, and then what are the sectors doing, and then what are the stocks doing?
That's right, because I believe, and this year is a great example, that the top-down influences are so strong, and if you've got that wrong, like you're pretty much wrong in like 70% of the stocks that you're owning.
All you need to know is dollar and rates, right? Like that type of thing?
Well, nowadays, the macro picture is so key.
To your point, yes, you could look at 300 stocks a week if you want to, but I don't want to say cheat code, but if you understand that the market is in a very well-defined downtrend, you will probably get less excited by any of the charts that stick out among those 300, because you already know you're fighting upstream.
Yeah, completely. And I mean, we still do the bottom up work. We still look at a lot of charts, hoping, I think, to see something different than what we're getting from the major indices. But in a bear market cycle, it's like everything is going down. I mean, there's no stone or no stock left unturned by it. So, we really defer to the S&P 500. We also start long term and then kind of drill into the closer time frames. Long term is going to set the tone. When you look at the intermediate term gauges, you'll give them more weight one way or the other, depending on the long term setup, right? So we know that we're in a downtrend with negative long term momentum. Well, then when we look at a MACD buy signal or some kind of buy signal on a weekly chart, we're going to be less likely to believe it. Right, breeds more skepticism around certain signals.
Everything is suspect as opposed to everything is confirming like bullishness.
Yeah.
Okay, so my analog for what's going on right now, and this might be like availability bias because what I've personally lived through, but when we were in 2021, I was saying this is 1999. I really feel like this year, 22, reminds me so much of like my formative experience from 2000, 2001. This doesn't remind me at all of '08. Like I'm sure there's some elements that are common, and I'm not even saying technically, but just like the nature of the types of stocks that are getting hit the most, the fact that it started with the most speculative stocks for a year before it started to hit like everything, like all of those elements remind me so much of the 2000 bear market. But you've probably looked at this a little bit more closely technically. Does that idea resonate with you? Or?
Yeah, for sure. I mean, they are different in the way that I think duration is going to be an impact. From that environment, it was, 2.5 year bear market. And unfortunately, that's the takeaway in a way. And I agree. It's like the character of where the bear market cycle has been sort of finding its downside leadership on those kind of like higher growth names, like the ARK-K type names. That feels the same to me.
Yeah.
And
those broke 18 months ago.
John, can you throw this chart up? So I made this today, Katie. It's almost hard to believe the down 80% club. So we're looking at, I'll just go through it real quick. Square, SoFi, BuzzFeed, DocuSign, Coinbase, Shopify, Unity, Twilio, Zillow, Robinhood, Zoom, Roku, Allbirds, Wayfair, Teladoc, OpenDoor, Peloton, Stitch Fix, and Bird. These are all down 80%. And you look at the chart and you're like, okay, Teladoc's down 91, Peloton's down 96. Same thing. What's the difference? No. For a company to fall 91% and then go down to 96%.
These weren't penny stocks, by the way.
No.
Multi-billion-dollar.
Peloton was a $49 billion market cap. It's now $2. But the difference between down 91 and down 96 is another 55% decline.
It's a good point, right?
So these are, it's massive. It's unbelievable. So to the point of like this being similar to the dot-com bust in that respect.
Yeah, because right. So like in the dot-com bust, you had companies that people were calling blue chip B2B internet companies.
Shopify was. It's down. It's 16 cents on the dollar.
Like we were looking at. I don't think they were $50 billion market caps then. I think maybe they were 20 or 30, but that was huge at the time. And we were referring to companies that had come public in 1998 as blue chip, purely because they were so big and well known. But those stocks would be down like 80, 90% like these.
Yeah, it felt like it was more about the branding than anything else, and that they rode this parabolic uptrend. The hard part about that bear market cycle was how, I guess, abruptly it started, or how quickly the bull market cycle ended. It was like an inverted V.
Do you feel that this was much different, though?
Yeah, a little bit on that side of it, just in that we actually had our longer-term momentum gauges roll over in October of last year, and that wasn't really the beginning yet. It was more we moved to a neutral long-term bias. We moved bearish in January.
But you had more time.
That was the top.
We had more time.
Yeah. Okay, let me answer this. So JC, we joke around, but he gives me a hard time saying that the market peaked in February 21. And maybe we're like talking past each other. Yes, enthusiasm. All of these ARK names peaked in 2021. When do you think the market peaked?
I think it was October. So I think it was late last year. I mean, obviously some segments topped well before that. And those segments probably are into a basing phase already. And yet you showed the risk exactly of buying into that weakness. I mean, a basing phase is usually a drawn out process. We saw this at the end of the 2000 bear market. And the retest can be super nasty.
Yeah.
Just,
We're seeing it now.
Cutting out the lows. Yeah, we're seeing it now
with
as
ARK.
we speak.
By the way, Shopify went from $212 billion down to 33. I mean, it's just wild.
Right, and this is the problem about looking for value in these names, because we just want to wait for it, wait for the market to be ready to embrace them again.
There were 5 major bounces in that 2000 to 2002 bear market. Mm-hmm. There were 5 episodes where stocks bounced more than 10%. And I think 1 or 2 of them were 21%.
20, 25 even.
Right.
Yeah.
So what's so difficult about that, and what I worry about in this version, we really had 3 bear markets then. They were all like one after the other. But if you think about, like, you had the initial bear market where the dot-coms got killed. The Berkshire Hathaway-esque stocks were really fine during that. But then all of a sudden you had the corporate scandals, which was Enron, WorldCom. Right. Those were 2 of the biggest companies in the market. And so that was another leg down. And then you had 9/11. So you had really 3 bear markets.
So these are the bounces that you're talking about. Yeah. So on top, those are the bounces from the lows. That was savage. So the S&P fell almost here we go. I'm sorry, it's on the biggest screen now.
Okay.
The S&P fell almost 50% in the dot-com bubble. It was worse for the NASDAQ, obviously. But the S&P alone saw a 19, a 21, and another 21 on the way to all new fresh lows.
And we already had one of those with
we
the
just
summertime relief rally.
A 21% retracement.
It doesn't feel like it, though.
No, that was in the... But people said you've never seen a bear market rally retrace more than 50% of the losses and then make new lows.
Another unprecedented thing, right?
Yeah.
So, but this is the concern now. So that was 3 bear markets. It was really one after another. So you couldn't recover. Like, you were almost about to recover from like Enron, WorldCom shock, and then the planes are hitting the bill.
Right.
Okay, so the concern now is, all right, we just had an inflation-driven bear market, and completely reasonable. We should have. We had a combination of overvalued stocks and 0% monetary policy that very quickly went to 4%. The bear market makes sense. Even if there were a recovery here, then it's like, all right, well, what's the next bear market? It's either this maniac in Russia does something, China does something, or S&P earnings start to get ratcheted down substantially. Like, you could almost have a bear market after a bear market. So like that, I think, is why there's still so much volatility, even if rates are kind of like...
And it's impossible to know what the next trigger would be. But I think when you see names like Apple crack, right? And Apple was the first go-to for the retail investor for safety, right?
Yeah.
So when you take away that perceived safety from the market, that in and of itself exacerbates the psychology that drives the next bear market.
And it's 7.5% of the market, of the S&P.
Yeah, that doesn't help
the
you.
nowhere to hide thing.
The
like,
nowhere
if you
to hide.
can't rely on Apple is like an aircraft carrier. So it's like you could sink some of my rowboats. I understand that.
And you know what's making new 52-week lows right now? Staples.
I know. And, we showed that a couple of weeks ago. Staples and healthcare were breaking down.
So what the hell?
And so right. So what are we left with in terms of long-term uptrends? There just aren't really any.
The dollar. And rates.
I know. And so not really a lot of people are willing to invest that way. So it really does leave us kind of thinking about the buy and hold strategy, right? I know a lot of advisors feel that markets are cyclical and you just kind of set it and forget it and it will come back. I agree. I think it'll come back. I think we're still actually in a secular bull trend going back to the 2009 low.
Do you think that's intact?
I do.
Okay.
Yeah. And I think, 3,200 though between here and there is very reasonable. And
would you change your mind? Would you say the secular bull is dead below 3,200 on the S&P?
It depends on the time frame over which that happens, because there's some support levels and trend lines that we're watching to that end. But hopefully we'd have an indication that the cyclical bear is turning into a secular bull before that actually happens. But we'll be kind of just rolling with it. We want to stay on the right side of the prevailing trend. And I think as it pertains to the buy and hold strategy, if you can just limit your drawdowns and remove, it's hard to be completely out of the market, and at a younger age, you don't want to be that. But to reduce your exposure to some degree, it just sets you at a higher bench for when you come out of this, right? So I really think this kind of environment is a testament to why market timing is so important. I know it used to have a bit of a bad reputation.
No, so we agree.
But why wouldn't you?
We agree with that. Actually, one of the premises behind the way that we founded the firm was that we actually don't think somebody with 8 figures in the market should sit there fully invested no matter what happens. Like, that's not.
Right.
You can't have a meeting with a high net worth investor who's retired
And say, don't worry, the market always comes back.
and say,
Right.
Yeah.
don't
But I
worry,
think
it'll come back. You could say that to a
advisors
40-year-old.
do say that. Yeah.
Well, it's true, but it's tough. I mean, yeah, they do come back, but how long are you willing to wait? And how much pain are you willing to endure along the way? It could be 11 years. Who knows?
And what if you don't? And what if you didn't have to endure all
Right.
of that pain?
Yeah, there just has to be an answer for how do you manage risk.
So we do that. We do that with technicals as well. Probably not the same way that you might do it, but like very early on, we realized like you could take economic data, you could take sentiment, you could take earnings, you could like take valuation, you could take all these things, or you could almost outsource that to the millions of investors who are buying and
Right.
selling on all of those things, and just take price.
Yeah.
And in the end, when you answer to clients, you're answering to them about price. So price is the signal that we
And
use.
I think we're all comparing ourselves to the S&P 500 when we get those statements. And so right or wrong, like it or not,
what it
that's
is.
what's happening.
So that's why we use right. So we don't. On the way up, you're worried about S&P 500 FOMO. Like the client is not long enough. If they're out of the market, they're looking at on the way down. It's the same thing.
Yeah.
It's like, oh my God, the S&P is crashing. Am I okay? So we use S&P as like the primary price signal that we're looking at. But like I feel very strongly that all things being equal, you should do very little. So if you are going to be tactical, your tactical model should not force you into doing trades all the time.
Yeah, I
So
agree.
then we're
It's a
talking about
longer-term approach.
Right. So then we're talking about like triggers that aren't overly sensitive, but sensitive enough. Time frames that are relevant to a wealth management client versus a hedge
Completely.
fund.
Yeah, that I
So-
understand.
So there are 5 names in the S&P 500 that are within 5% of their 52-week high.
How many?
5.
Oh my God.
Amazing.
Are they-
5.
And
It's Citru-
Enphase.
Do they,
It's
do they
Citrix.
all make cheese and crackers?
It's Citrix. Actually, it's Citrix, General Mills, Humana,
Mills, yeah.
Eli Lilly, and Nielsen Holdings. There are 187 stocks that are within 5% of their 52-week low.
And that's the breadth, right? So broad participation on the downside. We actually got an oversold reading in breadth coming into this week, but it looks like it's not
Does
mattering.
oversold matter in a bear
Take
market?
Well-
Citrix off your list because that was an LBO from January that I guarantee you Elliot wishes they never did.
Well, we all have some mulligans in our
right.
portfolio. But does oversold readings matter in a bear market?
For short periods they can, and it just depends on how bad it is. And right now it's seemingly pretty bad. So we're not getting the reactions that you would expect, especially when they're so widespread. I mean, we came into today with a 91% reading of stocks in the S&P 500 that are oversold based on our daily stochastic measure. And that's a very unusually high number. So we would expect normally some kind of rebound, even just days in duration from that, especially we also had a bunch of DeMark signals. We call them DeMark signals, short-term counter-trend signals that are derived from Tom DeMark's indicators.
Can you explain that to us? I feel like
Yeah,
that's...
I wanted to ask you about that because DeMark indicators are in a lot of your work.
But a lot of professional technicians like swear by it, and most people just don't know what it means. Like Josh was on TV yesterday talking about the 13 or whatever.
No, I was talking about a DeMark count, but then I realized there's not enough time on TV to like even get into
Like you can
why
explain
that might
it.
be relevant.
Katie, why don't you please
Well,
explain
they're-
it for us?
They're hard to explain.
Yeah.
It's explaining like a mathematical
No, it's exhaustion.
formula, right?
I do understand it. It's exhaustion in
what's
either direction.
But what are the numbers measuring? What are we looking at?
So think of it as having probably some basis in the Fibonacci sequence, which is something that is recurrent in nature and also in markets. Tom DeMark's a brilliant guy. I think he was even up for the Nobel Prize for Economics at one point as a nominee.
They gave it to Barry Ritholtz that year instead. Yeah, but Tom was
Well
right
deserved,
there.
Barry.
Tom was right there.
Yeah, and so Tom has just developed this suite of indicators of which we use his 2 kind of primary base level indicators. And they assign little numbers to price bars based on certain qualifiers that he back tested like crazy and found to have relevance in terms of identifying potential inflection points. So our goal is to not only know what the momentum is behind something, but if something's exhausting itself. And that's the goal of these indicators.
No, I know it's exhaustive.
Yeah,
but
it's exhaustive.
It's like
signals.
how extended is a trend? When is the rubber band going to snap back in both directions?
But so what's interesting about this indicator, as far as I can tell, is people say that technical analysis is part art, part science. It seems to me that this is pure science, or are you assigning these numbers, or is it done automatically?
No, I'm like a reporter.
Okay, right. So it's purely quantitative.
It really is, but in how you're using them and applying them, that's where the art comes in.
So the interpretation could be
because we talked about with the longer term picture, that's going to influence how we're looking at a daily signal or a weekly signal.
Yeah.
So we're going to be less likely to listen to the oversold buy signals. This event happened to have tons of the signals, which is when we really pay attention. It's when you have collections of signals. We also pay attention when a lot of our market internal measures flash green all at once. So when you have not just like percentage oversold, or not just the VIX, not just the put calls, but a collection of these market internals.
What makes them turn green?
Yeah,
when they're all extended to the downside.
Is dark red? Does dark red turn into green?
Yeah, so they're not all oscillators, but most of them are. So you can look back over history and see the market internals. Think about like the percentage of stocks above their 50-day moving averages. That would be a great example of one breadth measure that we track. When you have not just one.
So that's washed out. I'm looking at your chart right here.
Washed out.
It was 3%.
Washed out, but they were washed out 2 weeks ago.
They can stay that way, and that's the hard part, right? So you should defer to momentum before you go to the market internals, and that's at least in my process.
Momentum is still deeply negative.
Yes, it is still to the downside. So, and that's the risk. So when we talk through these things, we say, here it is, here's the level of conviction, and here are levels to watch on the downside just in case they fail, which is apparently happening right now.
Do you ever get asked by clients, okay, all of these signals are showing deeply oversold conditions. They're going green, meaning like
they're so bad they're good.
The mean reversion is about to kick in. Do you ever get asked by clients like, okay, so what do I do about it? Do I want to own the worst shit that's like down 70 or 80% for the bounce? I'm not assuming the bear market's over. I'm assuming a huge bounce. Or
the leaders.
Am I looking for the stocks that held up the best because the buyers will return to them fastest if the market goes green? Like, what's the right answer?
Gosh, I mean, it really depends on time frame, right? Because
short term, if you know bounce is coming.
Short term, you know bounce is coming, go for high beta,
Peloton?
high growth. I don't know. I'm not going to make a
recommendation. That's not ridiculous.
Don't tie me to Peloton here.
It's a treadmill.
I would never.
Let's not get ridiculous. No, but like theoretically, if you know you're just in it for the bounce.
The high beta names, because you're looking for outperformance.
So what is that now?
Always.
But are we saying high beta mega cap or high beta?
There are some semis that would be high beta, but I would say it's probably more like small and mid cap software names right now.
Okay.
Really
SaaS stocks.
Yeah.
Okay, biotech maybe even.
Some in biotech too. Yeah.
Okay.
So, and that's a little bit harder because there's some binary situations in biotech. As
Katie, you make such a good point about time frame. Right, because I think oftentimes people are talking past each other, and it's like we just have a different time frame. You're talking about literally like the next 30 days. We're talking about the next 36 months or whatever. So I looked at yesterday, going back to 1996, the NASDAQ 100, when less than 10% of stocks are above their 200-day moving average, which is fairly rare. Right, that's like a complete washout. There's never been a period in time since 1996 to today where it was down a year later. However,
welcome to 2022, though.
Well, yeah, I'm going to say this is probably the year it fails. But between now and a year, it could still go down a lot more.
And then recover.
And if you look back at corrective lows like the COVID low, we had these same types of green readings, if you will, in the market internal measures, and they stayed that way for about 3 weeks, right? So it was, in hindsight, better to adhere to the short-term momentum gauges than it was to believe in these market internals.
How do you track momentum? Are you RSI or what are you looking at?
We like the MACD, so moving average convergence divergence indicator, and it's just based on moving averages of price.
Why do you prefer that?
It smooths it out. And we're all about smoothing out the noise up until today.
Smooth is my middle name.
Yeah, there you go.
Noise is my other middle name.
And it's treating this day, actually, even like noise. So we'll see, of course, by the end of the day.
Oh, the MACD is not reacting to today?
Not when I looked last, but
maybe
that was an hour ago.
Maybe you should wake it up.
I assume you would rather be late to the bottom than early.
Oh, yeah. By all means. I mean, I think you want always to wait for confirmation. very important in our process for breakdowns and breakouts because shakeouts are or false breakdowns are so common. So even for the S&P 500, as we get into the summertime low, 36.36, 2 closes below to us as a breakdown, not 1. And
You wrote about the VIX, and you pointed out something that we've been pointing out on the show all year, which is that like VIX 32, 33, I don't care what you think of Ukraine, just buy something. Like that has actually worked really well this year.
This year, yeah.
As long as you didn't stick around too long. 36 is the high on the VIX this year. We're like 32, 33. That seems to be like blowing out here. The problem with that strategy is that at some point the VIX is going to run to 44 and destroy you.
The new bench will be higher.
Why isn't the VIX spiking?
But that's what I wanted to ask you about the behavior of the VIX. Given what we're looking at on our screen, I feel like that should be a 2011-esque VIX, and it just isn't.
It's not even close.
Yeah. So, I mean, there's some theories out there. There's really no way of knowing, but people are saying that, well, the retail investor is now hedging their exposure in different ways.
Oh, my God.
Okay, I don't.
Right?
Who just said that to you?
Dude, it's a
just
theory.
Say I said it.
It's a bad theory.
Why is it a bad theory?
All Katie said was it's a theory.
It's a theory.
But she said it first, meaning
and
that's the one
I'm
that's
not
most...
measuring it. I'm not tracking it. But if you go back and you look at the VIX, it had gotten to that kind of 80, 90 level at 2008 COVID corrective low.
Mm-hmm.
Other bear market cycle lows were closer to 50.
50.
Yeah, 50. But if you look at the 50 reading, the first 50 in a bear market cycle tends to see another 50-ish reading within the
We
next
haven't even seen that
9
yet.
months or so. That's what
It's
I mean.
32. What's going on?
So
But do
when
we have
somebody
to see it?
I think we do. Yeah, I think we do. Just because the character of the market. I mean, if you run a comparison versus 2008,
Boom.
which we have here, it's eerie, isn't it?
Wait. Set this up, Katie. Set this up for us.
So in the top, it's just the past year, and the bottom is 2008, and you can see
Purple is 08.
and see how the comp is pretty fair. Don't worry about the level. Just think more about.
I hope
the
this comp does not
posture.
hold.
I do too, and I'm not big on analogs. They can be, kind of meaningless at times. But this is compelling.
So I would just say though, like, look when that VIX really got going. Think about what was going on.
Yeah.
And I'm not saying it can't
That's
happen again.
That's when Lehman failed, right?
Lehman is the biggest bankruptcy of all time. The biggest corporations we have now are the ones that have raised the most cash and have the best balance sheets. I don't know that there's even a good candidate for a quote-unquote next Lehman, let alone Merrill Lynch, Bear Stearns.
Let's hope not, right?
No, I know, of course.
Yeah.
And then, like, Madoff is in here somewhere. Like, so I'm not saying we can't see a VIX 90, but maybe that shouldn't be.
I agree with you.
Okay.
I think it's more of like a 50 reading. So I think the takeaway shouldn't be that we get to 90, but rather that we could have a proper volatility spike still in store for us.
I'm with you
very
on that.
surprised
Yeah.
that we haven't had it yet, given that the market just is going straight down.
Yeah, and the sentiment, it sometimes is just like a slow-moving ship. It doesn't turn at the right times. And I think that's the hard part when people are getting ready to get back in. They're often late because that sort of slow ship of the sentiment doesn't turn at the same time the market does.
How do
right?
you incorporate sentiment into your analysis? And is it different on the way up than on the way down?
Yeah, we like the transactional gauges like the VIX more so than the investor polls, but we'll pay attention to all of it. And we care only when it's at extremes, right?
Why do you prefer the VIX to the polls? Because it's like what people are doing, not what they're saying?
Yeah.
Okay,
Just more
I'm
like
with you on that.
theoretically, it kind of makes more sense. There, do you remember the fear and greed index?
CNN,
Kind of lost its value a little bit. I don't know why.
They started putting Bitcoin and NFTs in there. That's
Stop.
why.
Oh no! Did
No,
they
no,
really?
I just made that up. It sounds like something that would happen.
Well, actually, you bring up a point though. With Bitcoin, which we cover on a weekly basis, we watch it very closely on a daily basis as an indication of how sentiment is for that day. So coming in this morning, down 4% or so, and I said, it's not going to be a great day, right? When you can kind of have this very far down the risk spectrum.
Yeah, they look
type
at
of
Bitcoin
asset.
as like they look at Bitcoin as a 24-hour, 7-day-a-week NASDAQ.
Yeah, there you go.
No, it's interesting though.
the correlations are very
Bitcoin's
high.
barely down today. It's at 19,400.
It could be worse, right? And
Could be way worse.
Well, it
Yeah.
is a store of value, so that makes sense. You talked about 10-year Treasury yields having an outside down day yesterday. So was that yesterday?
That was
British intervention day. Yeah.
All right. So I mean,
right at 4%. Mind you
you can't even start looking at stocks if your day doesn't begin with dollar and treasury yield, right?
Yeah, and it wasn't always like that, I feel like. But,
No,
but right,
right
now,
now.
for
Yeah.
sure. And I always feel like there's something like du jour, right, on the macro front. Thankfully, these are things that are digestible for me as an equity-focused technician.
Sometimes it's oil, sometimes it's the dollar. So right, sometimes it's like European banks.
Yeah, like
it's always going to
CDS,
be.
I don't know.
Right. So we know what it is today. Okay. What is an outside down day in 10-year treasury yields, and why should we pay attention to that?
Very short-term indication. But when you get an outside down day, it's when the high-low range for that bar encompasses the previous day's high-low range, and you get a weak close. So very simple. It just shows like a loss of intraday momentum that's significant.
So the range expands, but then it closes. The
And
yield
it
itself
closes
closes
lower.
down, meaning the bond closed higher.
Yeah, especially if it closes near the low of the day.
Okay.
That usually is a good indication of corrective action, right? So the takeaway, especially as 4% is in line. I mean, I was at a dinner not more than 2 weeks ago saying 4% seemed possible. And we said, well,
Now
maybe
it's
next
baseline.
year.
That sounded crazy.
See how
And
quickly
2 weeks later,
that happens?
The last time we
Yeah.
got a weekly candle, like the one that we're seeing now in 10-year, we pulled in. I mean, obviously, we'll
Yeah.
see, but
I mean, it's not a hard call to make, right? So 4% resistance. The support now is around 3.5, of course, because that was former resistance from the June high. So we have a higher support level with the follow through that we've seen. And I think more importantly, the takeaway is that this uptrend has good force behind it, good momentum, if you want to call it good. And it follows what was a major reversal of a multi-decade downtrend. So that downtrend had gradually been losing momentum, and then finally, just in the past year or so, we saw
it
it
lost
reversed.
it lost momentum at zero. That's where
Yeah,
most things lose
that's
momentum.
about when it.
But literally,
that when it
that's how
bottomed.
you think about how should the biggest, longest running bond bull market end? Probably at 0% yields.
Yeah.
It's poetic,
Seems
and
right.
that's where it ended.
so yesterday, the 30-year UK government bond yield fell more than 100 basis points.
Isn't that wild? I saw that chart.
I mean, this is
From what to what?
from over 5 to under
5 to
4.
4.
So this type of instability in global macro
Holy
is
shit, look at
very
this.
unsettling. And when you see this and you don't see the VIX spiking, it's just like weird. Like
Yeah, what are people paying
Yeah.
attention to, right?
You should have seen the British VIX. It went nuts. Can you use DeMark indicators as effectively or in the same way on things like bond yields or currencies as you do in the stock market?
Oh, yeah. Anything that has that kind of character where it has liquidity behind the price or the yield,
Yeah.
totally fair game. The only time where any indicator would really fail us, and this doesn't just go for the DeMark indicators, would be if you have a super gappy, thin, sort of illiquid type of market and chart.
Then it's noisy. And
Or you have something that's like binary, like a takeover candidate, or some FDA approval is anticipated, that type of thing.
Okay.
Otherwise, totally fair game, and the rest of it, it's more in the interpretation, right? That we're right or wrong.
So I'm looking at the way you're describing the market. You talk about short-term bias bearish, long-term bias bearish. But I know you must have many clients who are like long-only asset managers. So you want to be constructive, even though you know like what your view is on the market, and it just doesn't lend itself to what should we buy today.
Right.
But they want to. I think they want to be informed by you, but you have to find a way to be useful to them, even in a
Right.
period of time where, what their charter says they're supposed to do is just not what you would do. How honest are you with your long only fully
Completely.
invested clients?
I mean, listen, we have all types of clients, so we don't gear the research to one type, and it really is sort of general in its audience, let's put it that way. We do have long onlys, of course. We do have, day traders. It just runs all over the map in terms of the composure of our client base, and they all want to manage risk. Right.
Yeah.
So that right there is a primary takeaway where we're
Right, it's
giving
other
them
people's money, so they all want to do what's right.
right. So they all
Okay.
want to know what the bias is on the S&P 500 over various timeframes at a very minimum. Many of them like to really track the relative strength because sector rotation can be really important to their strategy. It's really important to our strategy. We find that it's the best way to outperform. So folks will come to us for that kind of relative posturing. We even have market neutral clients who just they'll ask the same question that you did about, well, off the low, what are we going to be buying first? You know,
so that's helpful.
Right. So we have ways to kind of look at the market from a very unbiased perspective, mind you. There's no sort of clouded judgment from the fundamental picture. And we can give them our honest view of support levels, what's risk, what's potential reward, what's the prevailing trend. And there's just inherent value to that unbiased view. But we are challenged in that for idea generation purposes, right? What do we put out there as a high conviction long idea? And I mean, we've put out a lot of long ideas because we have demand for that. And we started a Substack newsletter to that end as just like a supplement to our regular research product.
What is it? How do people find that? What is it called?
So it is called the Fairlead Strategies Idea Generator. And
Too
I
long.
think
Change it.
Starboard.
Stockton.substack.
Yes, it's something like that.
Okay.
It's easy to find.
But
Okay.
Katie, Josh, and I we have a YouTube show every Tuesday where we try and make the case for a stock. Obviously, we're not making recommendations, but last week I was looking and I was like, it's really hard to make the case for anything on the long side individually because it's just dangerous. So I just said NASDAQ 100 with the 1 year time frame.
Yeah. Oh, okay. So, and what we've been doing is more short-term work. So we're either like grabbing a DeMark signal and trying to leverage that with a really, really tight stop.
You have 48 hours.
It's all about all about the really
can I
tight
read what you
stop
wrote?
losses to manage risk. Sure.
So this is you. Tactics. Maintain underweight exposure to the equity market and risk assets broadly. Apparently, everything is now a risk asset.
Oh my God, it's such a bear market.
Oh, dude, bear market and Altoids, that could be problematic. Stay with top-down hedges until a short-term momentum turns to the upside. For example, SPX registers a daily MACD buy signal. Ain't happening today. After which plan to revisit increased hedges after a brief relief rally. So you're saying even if there's this relief rally that is so long overdue, that's just yet another opportunity to sell until proven otherwise.
Yeah, and staying hedged is important, and today is exemplary of why. When we have a fragile tape like this and momentum is to the downside, that we need that protection. And so that's what we've been imparting to folks. And then within that context, we talk about wherever we can find long-term uptrends. Right now, energy, utilities, no longer materials.
Materials look so bad.
But we have some little
The energy
little
stocks
pockets.
held the June July low though. They didn't break below. Everything else broke below.
And they don't have great momentum. Obviously, loss of intermediate term momentum within their long term uptrend. But trying to find the best of the worst. And
best of the worst,
yeah,
right.
so staples you can't find them anymore. Healthcare, it's tough.
You said
here and there.
sell stocks that have decisive breakdowns. Otherwise, giving them a chance to bounce off support for better selling opportunities.
Actually, Shopify is a great example of that. Look at Shopify. It was holding on to this support level of whatever,
Gone.
You
$30 or
have
so.
you have to
Gone.
be mindful of the stop losses. And I know it seems like a little bit trite or something. I just feel like
No, you have to.
you have
you
to.
have to.
And when stocks are in
Yeah.
downtrends, you can't just hope you're catching the bottom. Stocks, again, 91 to 96%. That actually happened. These stocks fell another 55% when they were down 91%. To think it can't go lower, they are going lower.
Right.
You said continue to avoid counter trend positions. What's a counter trend position?
And we honestly said that all the way through the summertime rally too. We were uncomfortable with that in terms of using that.
You were
2000
uncomfortable of what? Of what?
Of chasing that rally off the lows.
The June to August.
June to August rally.
And it was such a big one.
It was such a big one, and we got pushback on that. And listen, it was uncomfortable watching in 19, 20%.
People were like, Katie, when are you going to change your mind? We
Right. We got a lot of pushback on that call. But we had seen the playbook before, especially as it pertained to those, Shopify types of charts where they come off their lows and then these hard retests can often cut a new low. And so we were really uncomfortable
Brutal.
with the sustainability of that.
Spotify bounced, to use another Opify, Spotify bounced from 89 at the lows all the way up to 126. 89 to 126, now it's back down to 86. Just brutal.
And for the people that capture that, fantastic.
Great move,
But
yeah.
it's a hard recommendation to make because
Most
it is
people can't
so
do that.
hard. Well, it's so hard to capture.
Well,
And how- you don't know when to sell.
You probably
That's a
thought you probably thought
counter-trend move.
at that point you probably thought, oh, I caught the bottom.
Well, you feel like
Kudos
it's
to
broken
me.
out.
Yeah.
Yeah.
It is. It's breaking a downtrend.
Well,
and then
right.
it's not.
And then so many things. It was just wild how these 200-day moving averages acted as resistance,
Mm.
not just for the S&P 500, but for Microsoft and smaller cap names. It was really just
Tell me if this is at all consistent with your experience as a technical analyst. So my first exposure to TA, I worked at a brokerage firm. The whole idea of a brokerage firm in the late 90s, early 2000s was like the sales force gets really excited about a stock idea from the analyst. And then they're just calling their clients like, we got to buy this stock, this catalyst, FDA approval, like whatever the thing is, right? Okay. 3Com, they're going to spin off Palm Pilot, got to buy it, right? So all this stuff. And then like there's a technical analyst working at the firm also. And people are like, what is this nerd talking about? Shut up. We're pitching 3Com. Like get out of the way. And so whatever the stocks are that everyone gets really excited about, and then those stocks like start going down. And then all of a sudden I would see like a little bit of a line outside the technician, like outside his office.
Yeah.
Like, hey man, can I show you a couple ticker symbols? Like, what do you think? So
get some respect.
So I've found that in some ways the technician or the chart, people start like wanting to know more in a downtrend. I've also seen the other version, which is that technician will come out with research and they'll say, here's a really great intermediate term trade. This stock is working on, a 10-month moving average. It continues to find support at the rising 10-month, like a well thought out technical premise. And the brokers would be like, yeah, but what's the story? Like, why do I want to own Texas Instruments? Because my client doesn't want to hear about the lines on the chart. They need to be captivated by the story, or they're not going to send me a check for the trade. So I've seen technicians always be used as like either backup in a downtrend or be dismissed in a bull market when it was story time. Have you like experienced both versions of that a lot?
Yeah, and I think it's gotten
so how
better.
Angry are you in general?
I'm
No,
not too salty.
Okay.
So it has gotten better.
There's more respect for technical analysis all
and
over.
Just because more knowledge and more access to charts and more access to technicians, right? So 20 years ago, 25 years ago now, when I got into it, there was a lot of skepticism out there.
It's voodoo.
Mm-hmm.
Right.
And you'll see that here and there, but
not much.
Not from really widely respected
anyone who wears a bow tie is just not going to listen to you. You agree with that?
Yeah. Okay. I don't know. I should be wearing one sometimes.
Oh my God! I heard Jim Rogers say yesterday that this bear market.
That's a bow tie gentleman.
Speaking of bow ties, Jim Rogers said this would be the worst bear market in his lifetime. He's been around for a while. Come on.
The good news is he says that every year, almost regardless of what's going on.
But the technicians, they do get a good name in bear markets in a way. And I'd say it was really prevalent
100%
in 2008.
because they end up being right.
They're more right. And they're not precisely right necessarily, but as a group, they're going to manage risk typically better in a downdraft like 2008. And that certainly was when I felt like technical analysis really kind of made its name. And
but the knock on the technicians in a bear market is that they're going to be at max bearishness, like at the bottom.
Yeah.
When a fundamentalist may, not always, but may just be like, I don't give a shit what the chart looks like. This stock was 17 times earnings and now it's 12 times earnings, and I'm buying it. And you could take your chart and hit the road. Like I feel like there's some version of that, even though not all technicians will be bearish at the bottom. Many of them will be, because stocks will look their worst. As they get toward the lows.
Momentum-wise, right? And that's why we value things like the DeMark indicators and why we have this whole recipe for a bottom, right? It's a process, the retest, the support levels, the overbought, oversold measures, the divergences can be really informational. So we do have ways of feeling comfortable about a low, but we also don't need to be the hero.
Well, you don't need to catch the low, right? I know everybody wants to be the hero. You don't need to do that. And also, at the lows, Josh was making this point the other day, at the lows, things are going to look the blackest, right? Like, if you're just looking at price, things are going to look like the world is ending.
There, the VIX is at 50 or 80.
But there's also, at the low, it's interesting, it's not the max fear. The max fear precedes the low. The low is apathy. The low is, don't even tell me what the market's doing because it's irrelevant to me. I've already written my whole position off. I don't even care.
Right.
On the retail side, obviously professional, hopefully, would not get that despondent. But retail investors at a low are no longer afraid.
Right.
Because anyone who was afraid has already sold. That's how you got to the low. And then the people that are still long, they've like mentally just written it off.
They're just going to stick it out at that point.
Like you see that in crypto. This is like universal. This is universal. Like, oh, well, what's the difference at this point?
We're seeing it in cannabis right now. They just have
those are the worst stocks on the planet.
Well, they have this theory, right? And they're going to just own these companies because they believe in the theory. But also what you're talking about to some degree is how support is established, right? So if a fundamental analyst feels like, but also a fundamental analyst sees a valuation that is compelling and they publicize it and they, it makes sense from their DCF analysis, whatever it may be,
right?
Then that's what creates the support that does ultimately become the stuff of bottoms. But it is a process.
So I have bad news on that end. I forget who tweeted this, but this is from Bloomberg. Today, stocks broke through their June 16 closing lows, and if the XPX holds below that line into the close, it would mark a new low for the bear market. The multiple is hovering around 17.9 times earnings. Simply looking at PE ratios and taking the bear market's technical definition of a peak to trough decline, blah, 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 blah. This would still be the highest of any bear market low since 1957, according to Bloomberg data.
Wow.
We're talking about the PE. The other 13 instances identified in the past 65 years averaged about 12.6. The only other time that came close was in 2002, when multiples bottomed at 17. So again, the multiples for the PE for the S&P are 18. So if you're just looking at that very crude instrument, we're not there yet.
Right. Well,
it doesn't mean we have
2002. But we know that this bear market cycle has only been in force year to date. So
all right. So you are following. Let's do internals. So you are publishing U.S. market internals as kind of like a list, but broken up in different categories. So one category is breadth. So you're looking at advancers, decliners on the Thanks, John. Advancers, decliners on the NYSE, and you're looking at, what percentage of the market is oversold, above the 50-day moving average. You got an oscillator in there. Okay. Then you're taking sentiment, and you're doing fear and greed, AAII, and the VIX. Okay.
AAII is spiking. It's over 60.
The bearishness.
Okay.
But of course, that's because these are boomers typically, and they own bonds, right? So of course they should be bearish.
So then you're looking at leadership. You're looking at how many new highs, how many new lows, and then highs minus
not many
lows.
new highs, right?
Not many. That's an easy one to count. You can do it on one hand. And then volume. So I never understood how to read volume as either bullish or bearish, but I wanted to just go through these and ask you, how do you weight them? Like what? Because at a certain point, probably near a top or a bottom, these are going to conflict.
Yeah. So you know what? If you think about our process or methodology, market internals, like you see here, it's like third. So first is going to be support and resistance. Second will be all of our indicators. So momentum, overbought, oversold, relative strength. Third is the market internals. So we don't place a huge level of importance until we see extremes like this. Then we pay attention.
Can you go through this one more time? What are the three?
So support and resistance.
When you
levels.
Say, are you? Yeah. So I'm not a technician, obviously, but I was never into the diagonal support and resistance. I think the horizontal makes a lot of sense.
Yeah, I don't use trend lines all that much, which is kind of strange as a technician.
So you don't like shapes. You're not looking for it's a
Volkswagen. So you agree with me, or we agree that support and resistance are defined by actual buyers and sellers, not like...
Oh, yeah.
Okay.
Yeah, so not theoretical.
Right.
But we do have one model, the cloud model or Ichimoku, that is a little bit theoretical, but it's a bit more like a MACD than it is even a normal support and resistance in its derivation. So there are some nuance to that, but support normally would be like a former area of buying pressure.
Where buyers come back in.
Or maybe a Fibonacci retracement level if we don't have that.
All right, so what's number two?
So number two is the indicators. And we categorize in three ways. Trend following or momentum. So that's like the MACD. Okay. And then overbought, oversold, that would be like the stochastics or the DeMark indicators. Relative strength, which would be price-to-price ratios usually. And then we go to the market internals and look for extremes. So we're not busying ourselves weighting these. We're just saying, okay,
this is a lot.
Do we have a lot of green? Well, we do that intentionally. So in 2008, we got burned a little bit. We were just too late because of the put calls.
Who didn't, sister?
The put call ratios just kept getting more extreme. And that was like our primary sort of sentiment gauge, and we'd put a lot of weight on it, and it just kept getting more extreme. And we said, you know what, we'd probably be better off if we kind of diversified the way we look at the market internals.
Okay.
So that's really what we're trying to do here. We're just taking a bunch and letting them guide us collectively as opposed to individually. We're big on diversifying just kind of everything. And
So
that,
if I asked you like, what's your desert island indicator, you'd probably throw a lot of these internals out.
yeah, it wouldn't be these. It wouldn't even be the VIX as much as we value the VIX, which is probably our best indicator on there.
The put-call ratio kind of looks like the VIX in the sense that, yeah, it's elevated, but it's not spiking either.
It's not spiking, yeah.
So what would be your desert island if you had one? Not to put you on the spot.
I think probably
Price?
MACD, something like that, because it's
momentum.
price.
Okay.
But yeah. So momentum, and we generally, like, if you could just stay on the right side of the MACD as your prevailing indicator, I
See,
think
I would go hemline
yeah.
indicator. That's interesting. You want price. I want magazine covers.
Yeah, there you go.
Okay. All right, but you're not seeing. So you're seeing extremes in the internals like everyone else is, but it like doesn't seem to matter because this has been extreme really the whole time.
Yeah.
So there's something going on there.
It's just a bear market, right? It's
just a bear
the
market.
downside momentum. I mean, the momentum on the monthly charts, the monthly MACDs, if you will, I mean, it's across the board. And it's still growing. So it's not like we got any real respite from that with the summertime rally. And that's why I wasn't a believer in it.
It's so interesting. The psychology
Yeah.
of a bull and a bear is so different because to Josh's point, and to yours, I think that people don't trust bounces in a bear market, right? Because we're just sort of disinterested. The market's going lower. I don't trust it. It's fake. Market's going lower. But in a bull market,
They will buy the dip.
People don't respect the trend as much in a bull market with not every down day, but it seems like over the last 10 years, with every big down day, people were ready to call the top
Yeah.
in a way that they're not ready to call the bottom.
I understand
Oh,
that.
that's a
Yeah,
good
it's like
point.
a little
I haven't
bit
thought
of
about
market
that.
psychology, right? So they panic a little bit more,
Yeah.
right? So, but now we're seeing
People trust bear
declines that are-
markets. They don't trust
Yeah,
bull
but that's
markets.
also like who are you listening to and
No.
who are you talking
Yeah.
to?
Well,
If you're on social media, these people are the most sensitive to market moves of anyone on earth. The regular person is not even aware of things that people on Twitter act like are the end of the world. So I think there's like a high level of sensitivity. And so if your gauge of sentiment is looking at tweets,
Yeah.
you're probably barking up the wrong tree.
Yeah. No, it's a good point. I mean, Twitter definitely has its purpose, but it's not for that.
It ain't that. It's
ain't
to
that.
overthrow the government. Hey, John, can we put up this dollar index chart from Katie? Is this yours?
Yes.
I mean, and talk about a trend, right?
So show us like what. So when you look at it, obviously everyone understands at this point stocks are not going to make any upside progress so long as the dollar is like basically disrupting the entire global economy, right? Like we all understand.
Yeah.
We're locked into this dance now. What do you see when you look at this?
An uptrend, I'd say first and foremost, and that's one we want to respect.
All right, I think everyone would agree we see an uptrend. What else?
with the clouded, the cloud or the shaded area in the chart, that's a cloud model. So that's what we're respecting. And then we adhere to the indicators, right? So notice that it held above the rising 50-day moving average. That is a support level. And then notice also we've circled one of the DeMark signals, and that's a counter trend signal. Very short-term implications are for only 2 weeks. And we last had it in April, so we're paying attention to that as an indication that we'll get a little consolidation.
It could blow off short term.
Yeah, and it doesn't have to be dramatic, right? It could just be more
Okay.
grinding sideways back to the rising 50-day or cloud.
Could this inverse correlation between stocks and the dollar break at some point, or like
It
should
probably
it break?
will. Yeah, I mean, listen, I don't rely on any historical macro correlations.
Well, that's interesting. Why? Because you
Because
can't rely on them, right?
it, right? So
Okay.
they will matter at times, right? But I have no way of knowing when they're going to stop mattering, right? So it
So
doesn't.
you don't do this copper gold ratio stuff. You don't.
Sometimes I'll play around with it, but not on a systematic basis. And I'm really systematic in how I approach things. So,
Well, you know what's interesting about your approach, and it makes a lot of sense to me, is that you're able to be pretty unemotional about what happened with the
Totally,
market,
yeah,
right? Like
yeah.
you're very calm because you have your process.
yeah, and I prefer being bullish, right? It's a bit more fun, and it's a happier conversation with the clients. But yeah, I mean, we just wouldn't argue with the indicators. I mean, we feel like the market's telling us something, and we can certainly be wrong, but we blame ourselves because that's in how we're combining the indicators. It's not the indicators themselves. So we feel like we're just kind of acting as, aggregators of all this information, collecting it and creating an opinion based on that. And it's very factual, at least from our perspective, and very mathematical in its basis.
We're going into October, and
we haven't talked seasonality.
Well, that's where we're going now. See how good I am at
Yep,
this?
you're good.
All right. So there's like a little bit of a reputation for October to be one of two things, depending on who's writing the article for MarketWatch. It's either a bear market killer because the bear ends in October, or it's the most volatile month, and it's 1929, 1987, 2008.
Capturing those major downdrafts, yeah.
So I know that like so much of this is just like like religion, which fairy tale would you like to believe in today? All right, fine. But how do you? Because given how method driven you are, what do you do when somebody says, "Well, seasonally, we're getting into like a better time for the market than September"?
Yeah. I mean, I care. I definitely care. I want to know that, and it might influence my thinking to some degree, but not by a strong degree. I do think these seasonal phenomenon are real. You can go back and look at Bitcoin in September. It's like year 6 and it's down huge, right? So I do think they're real phenomenon, and I think there's probably a basis in either politics or macro cycles.
It's actually agriculture,
or that.
Yeah.
So I believe in that, but I'm not going to invest on that, right? So I'm not going to make or base any kind of investment or recommendation on a seasonal trend. But rather just kind of let it inform my biases otherwise.
Let me hit you with this old children's tale from the sea. Once upon a time, before even there was a Federal Reserve, money moved around in the form of gold bars. And every September, the farmers would call their money back from New York, where bankers were using it as a plaything and basically buying and selling stocks and bonds and having a blast. But the farms in September would say, we need the money back because we have to hire people to work the land and harvest everything. So you could set your watch by it. The panic of 1901, the panic of 1902, because every year New York had to give up the money, sell all their stocks, send it out to Kansas, Nebraska, whatever. They would pay the farmers, bring in the harvest. And
took it out of the market.
Right. And so once that's done, that's the seasonality. So all of a sudden, okay, the harvest is brought in by the end of October, send the money back to New York and London, let them screw around with it again. And then you would have like that seasonal trend.
Yeah. It's
and
like
then
harvest time.
So now that's no longer relevant. But that's from a time when like I think 3/4 of all men in America worked on a farm, like literally. And then the other 25% speculated with their money.
I think about the Fibonacci's, right? So the sequence is it's like a mathematical equation essentially. But the tides are spaced at this, right? So there are influences that are really hard to kind of grasp on the markets, right?
But you probably stop short of like where a lot of Fibonacci people would keep going.
Yeah, maybe. But think about agriculture.
Like you're not talking about seashells yet.
But we're talking. That there is that too.
Okay. All right.
But think about like moon cycles, right? I mean
I think about nothing else.
That influences the agricultural production. So there's all these things that are really interrelated, but not all that measurable. So we spend time on things that are measurable.
Yeah, I'm with you. I'm with you 100%.
Just price, like we're going to go with.
No,
price.
it's moderately interesting, and I know we're only talking one day here, but gold's flat on the day. And gold has
Thank
been,
goodness, yeah.
Why do you say that?
Because, it has outperformed, but we have one less asset class in an uptrend, and it's our supposed safe haven asset. So I say that in part because our TACK ETF owns it, but it is outperforming, but it's not going anywhere.
Could you tell us about the TACK ETF? We didn't even get there, and I don't know if you're like, all right, just like disclaimer, we're not selling ETFs on the show, okay? So everyone relax. For informational purposes, tell us about the TACK ETF.
Well, I mean, it's really obviously aligned with our methodology, right? So
I would hope.
It is like the manifestation of it. And you guys are long-term in your focus, and it also is that. It's designed to find the best sector trends with momentum. And when the market doesn't have that, well, then we'll go to these risk-off categories. And diversify it so that we don't get caught in like that, long-term treasury issue from Q1.
Yeah.
Where it was like you just had one or the other, and
Right.
then you just got killed in both.
Imagine that's your risk off as a 20-year treasury in January, February,
And
March.
we have a piece in that, but
Right.
but now we also have gold. We also have a piece in short-term treasuries. So we still have energy and utilities. And
How frequently will that trade? How frequently will TACK ETF's positioning change?
Monthly. So we're
Okay.
using month-end
Is
closing
it pure
data. for that.
quant, or do you get
It's
in there?
pure technical, and then it has some quant also in terms of the relative strength rankings. But
It's not discretionary, or it's not like subjective.
it's systematic.
Right,
100%, unless something really bad
Are you
happens.
allowed to say what the AUM is in that?
It's about 150 million.
Wow.
Great.
Yeah.
Good for
yeah.
you.
You know how you can make that like 15 billion? How we can 100x
I'm
that?
listening.
Just like be like Kathy Wood. Just get on Twitter and start mixing it up. What do you think?
Yeah. Stir the pot a little
Stir
bit.
the pot a little bit. Well, congratulations
Wait, when
on
did
that.
you launch
Is that
this?
the large? Is that
In
the
March.
biggest tactical ETF?
That's incredible.
Oh no. There's some big
The
ones
Dorsey,
out there.
right? Dorsey has some
Dorsey,
huge
Oh,
ones.
and,
yeah,
and
yeah,
that's
yeah.
my alma mater, if you will. So with the ETF, it's a great way to, you express the sector views, right, and then it can actually move fully risk off, which is not right now. But with that risk off piece, you can limit the drawdowns, but you're still going to be there in the sectors when the market comes out of it, right? And you're going to be there.
Who's your market maker on that?
We have Virtu.
Okay. And are they? Is it futures, or are they buying like the physical? Are they
Well,
buying the actual securities?
It's a fund of funds, so
Okay.
it's all SPDR ETFs, right?
Oh,
So we have
cool.
14 ETFs that we're choosing from, the 11 sector SPDRs. In like a full-blown risk-on type of environment, we'll have 8 and we'll equal weight them. And that's intentional because if it's like energy outperforming, which it has been, then we'll have a much bigger position in energy than the S&P 500 would. Where that could be a disadvantage is if it's like all about technology, right? 'Cause
I'm
that's
still
such a
not
huge
comfortable with
footprint.
the 11 sectors. I was a 10 guy, right? Like
A 10,
the
yeah.
communications.
They threw
They made real
threw a loop
estate
in
its
there.
own group. It used to be inside of
Financials, yeah.
financials,
Yeah,
but
yeah.
some of those companies got really big.
Yeah,
They're
that's
shrinking
right.
now, so don't worry.
I know. They look equally bad to each other.
Well, I've always thought that there was an arbitrariness to like what stock got assigned to what category. So like the example that I use is like Walmart and Target are not in the same sector.
One's
Walmart's a
staples,
staple,
one
yeah.
discretionary.
Which I don't
Seems a
really
little-
quite
Well, how
understand
about-
how they figured that out.
And what about some of the credit cards were financial, some were
Tech.
discretionary?
There was some
I think
tech.
Visa might have
I
been.
think MasterCard and Visa might be
Dude,
And
technology.
American Express is a financial.
Amazon is a consumer discretionary. Meanwhile, their biggest category is a staple. It's groceries.
Yeah, so
And cloud computing is the most high tech.
We're picking nuts.
So,
Yeah.
well,
Yeah.
I mean, these are big stocks, though. These aren't
Here's
like
how
minor.
I think about it, though. With those sort of sector ETFs, you are, in a way, making a fundamental or like establishing a fundamental view in the companies with the best market caps, right? Because those are going to be the most influential. So you're, as a technician, I don't do fundamental research. So I'm letting the market kind of direct me into those larger cap names, with the assumption that the market's rewarding the better companies, right? So we're going to have an oversized
Yeah.
position by default in an Apple type.
You're
of-
outsourcing the what to buy, and you're deciding on when to buy it.
Yeah, so it's market timing, sector rotation, and
Yeah.
relative strength, and then with the asset allocation
So
piece.
people can learn more about the TACK ETF. What is it actually called? TACK is the ticker,
so
TACK.
Fairlead Tactical Sector ETF, and there's a website.
Congratulations.
Yeah,
That's a big launch. 150 million.
Yeah.
So that's great.
And it's fairleadfunds.com.
Duncan, did you learn anything today?
I learned a lot.
You've been really quiet. Have you been taking notes, or
Yeah,
have you been
yeah.
trading? Are you trading the close?
What was the DMARC thing? I still am not quite clear on that.
It's this gentleman named Tom DeMark. Didn't like Steve Cohen make him famous? He was like Steve Cohen's technician.
I mean, he's still dialed in with these really top money managers, and
and he doesn't do any press. He's
there's-
like in the background.
He is, like I said, brilliant, and his
Yeah.
tools have a ton of value, and yet, they don't always work all the time, and that upsets people, and
Yeah.
they're treating it in a way.
That doesn't work all the time.
Doesn't work all the time.
What
You're
does?
fired.
Yeah.
So there is no holy grail, in terms of technical indicators. So I think it's in how you're combining them that you can really be successful. So when we're using DeMarc indicators and everything else, we're always cross-referencing.
Where's that sound
What
coming
the
from?
hell is that?
Something's going on out there.
Something in
something
Bryant
about
Park.
Bryant
Concert?
Park. Yeah, it must be something.
All right, we're going to go check out whatever concert it is. But this is the part of the show where we do favorites, and then we let you get out of here. We wrap up. So have you brought us any books, movies, TV shows, music, whatever your podcasts, whatever you're into, like what should our audience be clued in on?
Okay, so I'd say like work-wise, I have a new friend in Austin Hankwitz. Have you
Okay.
heard his name before?
No.
He's producing really good quality, digestible, like fundamental-ish research over Substack.
Okay.
But I found him
What?
through
How do you spell his last name?
Hankwitz, Hankwitz.
Got it.
His newsletter is called Rate of Return, and I think he's just crushing it because for me as a technician, I just want kind of like bullets and headlines and just give me the takeaway.
How did he get on your radar?
So I read an insider article that highlighted him as a TikTok sensation.
Okay.
And I said, well, gosh, he's got 500,000 plus
Yeah.
TikTok followers. I was curious. I had to log into my daughter's account to figure it out. And I thought
Were you
it was
horrified
really
at what you saw upon logging
yes,
in?
no, trust
Okay.
me. Yes, of course. And yet he was just doing this delivery that was so digestible, and it's also macro, and he's very open minded. But I think there's a real art into delivering it in a way that people that don't follow that can understand it.
Yeah.
So I value his stuff a lot. He sends out a couple things a week, and it's a great sort of 10,000
Awesome.
foot view. Yeah.
Well, check that out. It's the Rate of Return Substack by
Yeah.
Austin Hankwitz.
You got it.
Okay.
And then personally, I love Tehran. I don't know if you guys have watched that.
No, tell me.
It's a great show.
Netflix?
It is, yeah. And I feel like nobody talks about it. It's Apple TV, I think.
Oh, Apple
Yeah.
TV.
Hey, Ron.
Tehran.
Tehran, like in Iran.
Oh. I know what. No, I know what it is. I didn't watch it.
Yeah,
It's
we
good?
love it.
What is it?
Is it like Homeland?
It's definitely like a spy
I like that
series.
stuff.
I love that stuff.
I love that stuff too, and I just think it's really well done, and nobody seems to be talking about it. And it's a very cool, I'd say, view into a different world, right?
Okay.
And who knows how accurate it is, but it definitely is closer to accurate, right? So it's kind of.
Did you watch The Old Man? Mm-mm. Did you like The Old Man?
I didn't finish it because the plot got so
Yeah,
ridiculous
I
that
didn't
I
love the
couldn't
end.
stay with
I
it.
didn't love the end.
I liked it until the end. Yeah.
What was the Netflix show, The Israeli Homeland? What was that called?
Gouda?
Fauda.
Fauda?
Fauda. Did
I
you
didn't
watch
watch
that?
I didn't. Is that good?
People
Worth
love
it?
that one.
People loved it.
Yeah,
Okay.
yeah.
Put it
I
on
just
my
didn't get
list.
to it.
I love that stuff. What are you watching?
Well, I just took Sprinkles to Don't Worry, Darling, and this was the craziest movie that I've seen. This is my favorite. Do you know what it is? Do you know anything about it?
No.
Okay,
I know a lot about it.
you have to watch this movie.
You liked it?
I loved it. Like I want to go.
What is
I
it
want
called
to go
again?
back. Don't Worry, Darling. It is so effed up. Like it is so messed
That's
up.
so interesting. The big picture killed it, but I'm probably with you.
You know what?
I'm probably with you.
Here's what went on with this movie. There was so much controversy leading to the release because there was on-set shit that went on that was like really unsettling. This is the thing where they thought Chris Pine spit on Harry Styles or vice versa. Did you see any of this? So, all right. So
Olivia Wilde directed this, right?
Yes.
All right. So Olivia Wilde, who is a really good actress, she was married to Jason Sudeikis. There's a controversy with her.
Wait, they're not married anymore.
Right. During the pandemic, they split up. Nobody knew why. And then he served her divorce papers while she was like giving a speech somewhere. It was like really ugly shit.
Yeah.
There's kids involved. Okay, fine. So all of a sudden, she's directing this movie and Shia LaBeouf is going crazy on the set. He's like the lead male role. And who could have imagined this? Things aren't going well. He's got a very combative on-set persona, apparently. So they have to like fire him from the movie or he quits or something. And she replaces him with Harry Styles. And people are like, wait, what? She's dating Harry Styles.
Oh.
Harry Styles is acting opposite Florence Pugh, who's like this red-hot up-and-coming actress.
Midsommar, she's great.
You know who she is?
Yeah, I know she is.
Okay. So she's like on fire. Her career is like on fire. So she's on set. She's not getting along with Olivia Wilde, the director. Olivia Wilde's also acting in the movie, playing her best friend.
While dating Harry Styles.
And then Chris Pine, who played Captain Kirk in the new Star Wars movie, you know the actor. He's involved. And there's like all kinds of on-set stuff to the point where they're now showing the film at film festivals and the cast won't show up. Like they won't come to the premieres.
Wow.
Right. So that goes viral on social media, which actually turns out to be like a good thing for curiosity But then the critics, I think, got caught up in that, and so they didn't give the film good reviews. But people are going anyway. So it's so the movie is so messed up that I can't.
So you can feel like the tension, or what is it about?
100%.
Yeah.
And everyone's performance is really good and really believable. And it's like it looks like a romantic comedy or from the outside, but it's hardcore science fiction. But I can't even describe. I don't want to like give any of it away. But if you want to go see a movie theater movie,
Okay.
this is so cool.
Well, I'm seeing a movie theater movie tonight.
What are you
I'm
saying?
actually trying to buy tickets right now. It's not working. Avatar.
Yeah.
I can't wait.
There's another one.
Maybe skip that.
Why?
Giant Smurfs.
You're an idiot.
Okay.
You don't know what you're talking about.
All right.
Giant Smurfs.
2 podcasts I want to give you. Jeff Curry, who's the head of commodities for Goldman Sachs, was with our friend Meb Faber. This is a must-listen episode. And he's had Jeff on before, and Jeff does a ton of media. You could see him other places. But something about Meb really knows how to get, the best out of his guests.
Yeah,
He's a very good podcaster. So Jeff was great just talking about the oil rally and the commodity super cycle. The other one is Scott Galloway has a new book, and he was on Dimitri Korfinas' show, which I think is called Hidden Forces. Do you know the show?
I don't know who that is.
Great pod. I know Dimitri. And he also had Nick Timiraeus on.
Oh, wow.
Who is like the Fed whisperer.
Yeah.
So check out Dimitri Korfinas' podcast. Check out Meb Faber. And go see Don't Worry, Darling. Do you have any, besides Avatar, do you have any
What's
favorites?
wrong with you?
What? You love that movie?
You don't like James Cameron?
No.
I thought it was good.
Overrated.
It was weird.
You don't? Overrated? What?
Avatar?
How is James Cameron overrated?
No, Avatar. It's just okay. It wasn't like meaningful to me. I guess maybe the time in your life that you saw it, it was like a more meaningful movie.
Okay.
How old were you when the first Avatar came out?
What was it, 10 years ago?
No.
More? 15?
Yeah.
I don't know.
When did Avatar come out?
2009.
Duncan definitely has
2009.
You definitely have a scorching Jim Cameron take.
I mean, actually not.
Okay,
No.
great.
I was going to ask though, did you ever see the video of David O. Russell and Lily Tomlin fighting on the set of I Heart Huckabees? It made
No.
me think of it with. Oh, you should look it up. It's crazy.
like on set drama.
Just like cussing each other out, shouting. Someone had a camera rolling. It was rough.
Yeah. You didn't see this movie yet?
No.
The cinematography in this movie will blow your mind.
Okay. I'll have to
It's
look
like
it up.
it's a community they built in a California desert. So it's like palm trees, desert, and then 1950s style houses, because that's when it's supposed to take place. It's pretty wild.
cool.
Huh, sounds good.
Visually, you'd be inspired. All right, we're gonna wrap up from here. Our thanks to Katie Stock. Did you have fun today?
Yeah, I did.
You were
Thanks.
awesome.
Thank you so much
were
for
awesome.
coming by.
I knew you would be awesome. I wasn't
I
worried.
appreciate it.
But yeah, we're so happy to have you. Where can people find your, how do people look into your research product or find your stuff? Where do they go?
My website, fairleadstrategies.com.
Okay.
We didn't get into the nautical bit.
No, we will though.
We will next time. And at Stockton Katie
Okay, at Stockton Katie on
Twitter.
On Twitter, where you are very
And
combative.
I will never DM you.
Okay. You won't sell anyone crypto on a DM? All right, Katie, you're awesome. Thank you so much for coming. Really
Of course.
appreciate it. Everybody check out Katie Stockton's stuff. Follow her on Twitter. Subscribe to her product, etc. You will learn a lot. That's it for us this week. Duncan, anything we have to say?
Oh, no, what are your thoughts next week? It's Yom Kippur.
Oh, no, what are your thoughts? Michael will be you'll be in Temple, or you'll just be...
I'll be somewhere.
You'll be at home, not on electronics.
Right.
Okay.
Definitely not.
All right. No, what are your thoughts next week? But Animal Spirits, new Animal Spirits next Wednesday. We will see you then. Thanks for listening, guys.